Well, nervous investors are keeping a close watch on the Federal Reserve meetings going on as they decide whether to raise interest rates for the first time in 9 years. Raising that interest rate could affect everything from home and auto loans to interest rates for credit cards. Financial expert Tom Stockett from clevelandwealth.com is here now to break it all down for us. Tom, thank you so much for being with us tonight. All right, so what's the latest? Do we know when the Fed will act on this?
Well, that is the million-dollar question right there, isn't it? Right now, the Federal Reserve Committee is meeting today and tomorrow. There'll be an announcement tomorrow afternoon. Going into this meeting, I'd say it's divided almost 50-50 as to whether or not they're going to raise rates or push it down the road maybe to December. I think it's important to look that they have not raised rates since 2006. We've been in an easing cycle since that point, and that's why there's a lot of anxiety around this. And lastly, I think it's really important to see that Janet Yellen, our Federal Reserve chairperson, she has announced on several occasions that when they do start tightening or increasing those rates, it's going to be very gradual.
Okay, what would a rate hike mean for all of us in terms of getting a loan and how much money we have to spend?
Well, there's no doubt that it's going to create additional expense for all consumers looking to access credit. And it's really coming in at probably three different areas for American consumers. First and foremost, mortgages. As rates get hiked, mortgages will become more expensive. Auto loans, once again, as rates go up, auto loans may become more expensive, as well as leases. And lastly, credit cards. I read a statistic the other day that if rates go up by 1.125% over the next year, that it would cost the American consumers $2 billion in additional financing expense.
Now, if you have good credit, though, would you still be able to get a lower rate for a house?
Well, better credit is always going to be reflected with a lower rate. However, rates in general across the board are going to increase as rates begin to rise at the first level, the Fed funds rate in the Federal Reserve.
And how about the stock market? A lot of nervous people on Wall Street.
Well, Wall Street does not like uncertainty. More specifically, investors are concerned that increased borrowing costs, as well as the strengthening of the U.S. dollar against global currencies, could cause global headwinds and economic headwinds in this economy.
All right, Tom Stockett, thank you so much for
having me.
Tonight.
All right, bye-bye now.